Okay, so capital assets. Remember, these are personal use assets or investment assets. Okay, so they're not used in a business, right? Again, it doesn't matter the type of asset it is, it matters how we're using it. So, how we calculate any gains and losses on capital assets is pretty complicated. There are a lot of factors that we have to consider. And this, again, this is only for individuals. There are different rules on capital assets for corporations that we're going to talk about in chapter 15. This is only for capital assets that are held by individuals or by businesses that are owned by individuals. If it's a corporation, they've got different rules. Okay, so everything pertaining to that Form 1040 and the Schedule C, or individuals who own property privately, private use property. So these are the determinants in how we calculate the gain or loss. So we need to know how long that capital asset was held. Again, that 1 year cutoff is important. 1 year or less is short term, more than 1 year is long term. Whether the sale of the asset produced a gain or a loss. You'll see that if we have a gain from the sale of an asset, then we are going to have, it is going to be subject to taxation, and the tax rate that it's going to be subject to will be dependent upon how long we held that asset. But if we realized a loss from it, we may or may not get to take that loss. Okay, and we may not get to take all of that loss. So you'll see, because there are some limits on capital losses. The type of capital asset that was sold. So there are different types of capital assets. Again, investments and personal use property. Collectibles are a category in and of themselves. So if it's a collectible asset, so think about, grandma's big, I keep using grandma, Hummel figurine collection. You guys know what Hummel figurines are? Here's a little figure. My grandma had them. Anyway, so those are collectibles. They have a different tax rate. They're treated a little bit differently. What tax bracket the taxpayer is in matters as well. So remember, if you recall with the dividends, it mattered. They got preferential tax treatment as a qualified dividend, but that tax rate depended upon what tax bracket the individual was in, right? The more income, the higher that dividend tax rate was. You recall, everybody remembers that? Same thing for capital assets. Also, we have this issue of netting the capital gains and losses. So, capital gains and losses, multiple capital gains and losses on a tax return are netted together. They're combined. And there are different rules depending upon whether it's a net gain or a net loss, or a net short-term gain or a net short-term loss, or a net long-term gain or a net long-term loss, or some combination of all of them. Okay, so we have to combine them, and they get combined in a certain order.
So you talk about for dividend. So dividend is long-term or short-term?
So dividends are separate from capital assets. They just have they can have the same tax rate. So the dividends are treated, if they're qualified dividends, they're treated like short-term capital assets for tax purposes. I shouldn't say they're treated like, they're taxed like short-term capital assets.
Yeah, that's what I want to know. So the dividend never go in the long term, or it can be long term.
We don't really think of dividends in terms of short-term and long-term. Yeah, it's just that they share that tax rate with the short-term assets, but only again if they're qualified dividends. So qualified dividends and long-term, I said that opposite. So qualified dividends share a tax rate with long-term capital gains. These two share the same preferential tax rate. So when we talked about those qualified dividends, we're gonna come back to those same tax rates. If it's a long-term capital gain. If it's a short-term capital gain, or an ordinary dividend, we also have the same tax rates. We call these ordinary rates. Okay, these are capital gain rates. Well, I should say short-term capital gain rates. That is a brand new marker. This makes me happy. So, as I just want you to kind of recall with those qualified dividends, that we use that special tax rate, we're gonna use those special tax rates, we're gonna use them again when we talk about long-term capital gains. So, assets that are sold that we've held for more than 1 year. Okay, so we get all of these different factors that we have to consider, and all of them determine then how we are going to treat those capital gains or losses and how we're going to tax them. Okay, so we already kind of talked about this holding period. So long term again is greater than 1 year. And remember, the starting period is the next day. Okay, so if I bought something yesterday, my starting period is today, October 24th. If I then sell it on October 24th next year, I haven't held it for more than 1 year, right? So long term is greater than 1 year, short term is equal to or less than 1 year. So exactly 1 year would be considered short term. Okay, so if you have an asset and you're right at 1 year, wait 1 more day, because you're gonna get preferential tax rates with the long-term sale as opposed to the short-term. They use this example. Jackie purchased 100 shares of IBM, so this is a security. January 6, 2021. The stock is a long-term asset as of January 7th, 2022. So kind of think of it that way, a year plus a day. Okay. If it's sold before January 7th, then it is a short-term asset. So normally we purchase these assets. Normally we attain them through purchase, but again, there are other ways that we can attain these assets, which we just kind of went through a little bit there. If an asset is purchased, obviously the fair market value of that asset is going to be whatever our purchase price was, including all fees. So a lot of times when you purchase a stock, you'll oftentimes have to pay some sort of like broker fee or something like that. That's included in the basis of that stock. If it was received by gift, non-taxable exchange, or inheritance, then there's some different treatment, which I kind of gave you a preview for the last on the last slide, but we'll go through this again. If the property received has the same basis as the basis in the hands of the transferor, then the holding period would also transfer over. So that was the example of the gift. Grandma gives you the house, 1972. Your holding period starts 1972. But if you inherit it, then your holding period starts, if you inherit it, it's still going to be long-term. So you get the benefit of both, right? Inherited property is always long-term property regardless of how long it was held. So you can see, remember I said that there are some special collectibles get special treatment. Collectibles have a special tax rate. It's a 28% tax rate. This 1202 gain, it pertains to certain small business stock. So stock for businesses that aren't publicly traded. So qualified small business stock also has a tax rate of 28%. Unrecaptured 1250 gain, which we're going to talk about a little bit later in this chapter. 1250 gain is a type of gain that pertains to 1231 property. I don't know if you recall 1231 property, that's the property that is depreciable property that's used in a trade or business. 1250 property is real property, so it has a special category, and we'll talk about what unrecaptured means as well, okay? So, capital gains, these are our tax rates. These are the same tax rates and same brackets as with qualified dividends. I don't like how they present this here, but I guess it'll have to do. So, capital gains based on taxable income. So if you're single, it's over $459,750, you're in the 20% tax bracket. Again, this is only for long term. If it's short term, it's going to be whatever your ordinary tax rate is. Okay? Next category or next bracket is 15%, and then the final tax bracket is 0%. So it's entirely possible if you have a long-term gain and you are filing as married filing jointly and your taxable income is $80,000, you don't pay any tax on that capital gain at that point. Okay. Matthias. Okay, so let's see what Matthias has done here. Matthias gave a gift. Okay, so this is a gift. Gave a gift of 500 shares of GM stock to Sienna. Sienna was his sister. On November 12, 2021, the stock was worth $50 per share. So his total basis, would be 500 shares times $50. Okay, so what, $25,000? Do I have that right? Yes. 1, 2, 3. So Matthias had purchased it though, that's what it was worth when he gave it to her. He purchased it originally in 1992. It was $30 a share. Boy, that's pretty poor appreciation for that stock, if you ask me. So his basis is going to be the 500 times $30 a share. So $15,000 for his total basis. Because the basis to Sienna would be the same as in the hands of Matthias, the holding period would be his holding period. So she's going to get a long-term holding period as well because he purchased it in 1992 because he had held it for more than 1 year. When she sells the stock, any gain will be taxed using those long-term capital gains tax rates, provided they're still in effect when she actually sells it, because as we all know, taxes can change, right? So in this case, let's see if we can do kind of a little, use this as an example. Okay, so he bought it, what was it, 1992, so 500 shares, $30 a share, $15,000 is his basis. Gifted it, 2021, 500 shares. It was worth at the time $50 a share, so $25,000, but this is not the basis, right? This is still going to be Sienna's basis. Let's say Sienna sold it in 2022, 500 shares, and it was worth $60 a share for $30,000 sale price. She has a long-term holding period because she gets to use Matthias's holding period of 1992, so that's way over, what is that, 30 years? Is that 30 years? 30 years, holy cow. to figure out what her gain is, we would just take the sale price of 30,000 minus her basis, 15,000. So she got a $15,000 gain. If she's in the 15%, it's a long-term gain, right? Long-term, so we would get to use those long-term tax rates here, those long-term capital gains tax rates. Let's say that she's married filing jointly and her other taxable income is $100,000. That means she's in the 15% tax bracket for capital gains, only for this income. The rest of her income is still gonna be subject to those ordinary tax rates. Okay, so 15%, what's 15 times 15? Somebody, I can't figure this out, 150 to 2250? Is that right? So she's got $2,250 tax liability only on the gain, right? So her other income is gonna be taxed as well, but we gotta add those two together. So remember when you did that for the qualified dividends, you're gonna have to do it again now, okay? All right. So we talked about those capital gains tax rates. Now, long-term capital gains, they didn't include the 0% here. I don't know why that. 0%, 15%, 20%, 25%, and 28%. Now, they include in here these unrecaptured 1250 gains, 1202 gains, and collectibles gains because they fall under the category of capital gains, okay? What do I want to say here? So this is just going through the rates here. These are the, I already kind of told you that, all that stuff. So we've got Basha, married taxpayer files a joint return. 2022, their taxable income is $115,000. She sold stock that was held for 4 years. Is it long-term or short-term? Long-term, that's right. She held it for 4 years, more than 1 year. The gain on the sale was $30,000 because of her other income of $115,000. She's married, falls in the 15% tax bracket. So you do need to know what the filing status is for that as well. Then the rest of her income is taxed at 22%. Well, her marginal tax bracket is 22%. We know that her average tax rate is not going to be 22%. It's going to be less than that. The $30,000 capital gain, though, is taxed using just that 15% tax rate. Okay? All right, so this 25% tax rate, what's this here? You guys don't realize how happy this makes me to have a brand new marker. It erases so nicely too, you have no idea. Okay, so the 25% tax bracket special rate that relates to capital gains that are generated from depreciable real property. All right, so this is, remember, real property is real estate, right? This is not going to include land because land doesn't depreciate, right? So we're talking buildings here for the most part. So depreciable real property used in a trade or business. Now remember, if you had a building that you were using in your business, you were able to depreciate it over the years. That amount of depreciation offset ordinary income. So if your tax rate was 32%, it offset at the 32% tax rate, right? So if it's offsetting at the 32% tax rate as you're depreciating it, but then when you sell it, all of a sudden you only have to be taxed on maybe 15 or 20% tax rate. Well, you're getting quite the tax advantage there. So what they did was they instituted this different higher tax rate to help recapture that depreciation. Okay, but it's not. how it works, it used to be more relevant back in the day when property wasn't depreciated by straight line methods. Now that it is, it's not quite as relevant. So again, this is only depreciable real property used in a trade or business. This is called the 1250 property, okay? And you're gonna see a chart when we get down here. We've got 1231 property. Remember, this is depreciable trade or business. More than 1 year. There are two types of 1231 property. There's 1250 property and there's 1245 property. This is what we're talking about here. This is depreciable real property. Again, used in a business. Of course it's used in a business. This is used in a business too. Okay, depreciable real property, so it would not include land. We'll talk about the 1245 property here in a couple minutes too. So what they did was any property, so they changed the depreciation methods. It used to be that type of property had an accelerated depreciation method. So it meant that you're gonna take more depreciation up front than if you had used the straight line method. What they would do is if you sold that property before it was fully depreciated, you'd have to go and recalculate what the straight line depreciation would have been. And if you received additional depreciation, then you'd have to recapture or bring back that depreciation, and it would be taxed at this 25% tax rate. So income that's part of the gain. So when depreciable real property is sold for a gain, taxpayer has to recapture as income that part of the gain due to the difference between maker's depreciation and straight line. However, as of 1987, all of that property is straight line. So there's really no additional amount. IRS implemented a special provision for non-recaptured depreciation of real property. So now it's not recaptured depreciation, it's non-recaptured. So this is called unrecaptured 1250 gain. So what they did was they changed it to all of the depreciation that you had taken on it, all of the gain that's attributable to the depreciation that you took on it is going to be taxed at a different tax rate than the gain that's attributable to appreciation of the asset. So for example, let's say we bought a building for $100,000 and we took depreciation of $10,000. So our basis, adjusted basis, is $90,000. But we sold it for $110,000. So obviously our gain is $20,000, right? Well, only $10,000 of that is attributable to the increase in value of that building, right? We got $10,000 of that gain because the building went up in value by $10,000. But we also got $10,000 of that gain because we got the advantage of depreciation. So we have to separate out. 10K will be a capital gain. 10K will be a 1250 gain. They're going to be at different tax rates. Okay? I love the expression on your face. You guys, if you could see Ann when I say these things, he's just like, this is, why did they make it so complicated, right? All right, let's look at an example here. So Mustafa purchased a building in November of 2008 for $200,000. He assumes that $69,655 of depreciation was taken on the building. So the adjusted basis is $130,345, the $20,000 minus the $69,655. If he sold it for $90,000, so He bought it for $200,000. Now he's selling it for $190,000. He actually hasn't had any appreciation on the value of that building, right? It's gone down in value by $10,000, which means all of the gain that he recognizes is going to be from depreciation. So he got their recapture, it's gonna be at a higher tax rate because he got the benefit of that tax deduction over the years through that depreciation. Not because the property increased in value, but because he adjusted the basis downward through depreciation. So this would be a long-term capital gain, still considered to be a long-term capital gain, but it's got a special tax rate of 25%. If he sold it for $220,000, now this is different because $20,000 of that gain is attributable to the increase in value of the building, right? It went from $200,000 to $220,000. So it went up, so $20,000 of it is going to be what's called that 1231 gain, which is going to be at special capital gains tax rates. So it's going to be a lower tax rate depending upon other income, but the amount that was due to depreciation, let's see, $69,655. Yeah, because the total gain's $89,655. $20,000 of it is attributable to appreciation. The rest of it was attributable to depreciation of that property. So that amount is going to be subject to the 25% tax rate. Does that make sense? So the amount of any gain that's attributable to the increase in value of an asset is going to get those long-term capital gains tax rates, as long as it was held for more than 1 year, right? But the amount of any gain that is attributable to depreciation that has been taken on 1250 property, again, this is only 1250 property, which is depreciable real property used in a business, is going to be at a 25% tax rate. What they're trying to do is take back the tax benefit that was received through depreciation, right? So it's going to be at a special tax rate. Collectibles gain or loss. Collectibles gain is 28%. So there are specific definitions of what a collectible is. A collectible, again, it's not necessarily a category or type of asset, but it's what you do with it, right? If your intent is to collect it, it could be a coin collection, it could be art collection, you know, all that sort of thing. It has a 28% tax rate. Also, these 1202 gains, which again, this has to do with purchases or certain type of small business stock from a qualified small business. We're not really going to do anything with that, called a QSB, QSB, qualified small business. And they give you the definition here of what would fit for qualified small business. Usually those are going to be like S corporations, smaller, more family-owned kind of S corporations. Let's see. Oh, this is the qualified small business. Well, I can show you how it kind of works here. I invested in a mid-sized local corporation. So this is not any stock that you can purchase on a stock exchange is not going to be a QSB stock. Okay, that's not going to qualify. But this, a mid-sized local corporation, gross assets of 15 million. So they tell you the asset limitation, I think, is 50 million there. She purchased 500 shares for $25,000. In 1999 and 2022, she sold it for $45,000. She had a gain of $20,000. One half of the $20,000 gain is excluded. Let's see. I didn't read the whole thing. So, taxpayer other than a corporation that purchased this type of stock, gross income is excludes 50% of any gain from that. But the rest of it is subject to a 28% tax rate. Okay. Okay. This is, so there's an additional Medicare surtax, another tax. So this isn't the additional Medicare tax that we talked about with earned income. This is different. This is a tax that is on net investment income. Okay? For individuals, higher income individuals, so with a modified AGI of over $250,000 for married filing jointly or qualifying widow or widower, $200,000 for single or head of household, or $125,000 for married filing separately, any of their net investment income, if they have other income that exceeds those amounts, is subject to an additional Medicare surtax. This was implemented with the Affordable Care Act to help pay for the Affordable Care Act. So again, it's only going to be on the amount that is over that limit. So for example, put together an example here. Let's say we're married filing jointly, and $260,000 is our income, and we have net investment income, NII, included in that of $30,000. Only the amount that takes us over $250,000 is going to be subject to that additional Medicare surtax. So you could take the 260. How am I going to do this? Minus 250. This is our max. So 10,000 of that 30,000 is going to be subject to net investment income tax. So it's only the amount that takes us over those limits that's going to be subject to that. Now, if our income, if we were married filing jointly and it was 290,000, well, now 290 minus 250, 40,000. That means all of that 30,000 is over, pushes us over the 250 mark. All of that 30,000 is going to be subject to the net investment income tax, or net investment income tax. Okay, so it's for high income earners who have investment income. Investment income, interest, dividends, capital gains. Also, for individuals who own shares in a small company, so S Corp owners, if they're only investors, so they don't offer any services to that company. They just give some money to invest in it and hope that the company grows in value. That would be considered an investment. This was a big deal. So higher income individuals will spend a lot of money for tax planners to find ways around this, because that's just an additional tax on them. So how can we reclassify that income so that it's not investment income, right? Because it pushes it, then they're subject to that additional income tax, or that additional net investment income tax. All right, questions?